Hello, everyone, and welcome to 5 Paisa special show. I'm Avan Dabash. आज हम एक यूनिक ऑफरिंग के बारे में बात करेंगे. The cheapest and straightforward way to hold India's 10 largest stocks through an index fund. ये वो top 10 companies है which have stood the test of time, offering better stability due to higher ROE and higher ROA. और ऐसे ही स्ट्रॉन्ग फंडामेंटल्स की वजह से निफ्टी टॉप 10 इक्वल वेट इंडेक्स ने निफ्टी 50 इंडेक्स को 11 आउट ऑफ द लास्ट 16 कैलेंडर इयर्स में आउट परफॉर्म किया है. And today we want to put the spotlight on DSP Nifty Top 10 Equal Weight Index Fund, जिसका NFO open हुआ था 16th August को till the 30th of August. So, ladies and gentlemen, join me in welcoming our guest for today, Mr. Gurjeet Kalra, who's the business head, passive funds at DSP Asset Managers. Thank you so much for being with us. Why don't you give us an overall view? The NFO Open hua 16th August to the 30th of August. Tell us a little bit more about DSP Nifty Top 10 Equal Weight Index Fund.
Sure. Thank you. First of all, thanks a lot for that introduction and 5 Paisa for giving us the opportunity. I would also like to thank everyone present in this session for taking out your precious time. It's very easy for me to actually talk about this product because the entire product is summed up in the name of the product itself. So it simply is DSP Nifty Top 10 Equal Weight Index Fund or ETF. So we are doing two versions of the product, both index funds and ETF. It is a portfolio of top 10 stocks in the Nifty. Each stock will have a 10% weightage. So 10 stocks at 10% each, constituting 100% of the portfolio. So it is that simple a product. And the 10 names are names that people are aware of. They don't really, there are no unknown names in this portfolio, and that's the reason these stocks are the top 10 stocks. They are supreme in terms of quality, which we will discuss during the course of the session. They are they have outperformed the broader markets over larger periods of time. They provide relatively better comfort during the times of market corrections. So that is what the product is all about. I will take everyone through a couple of slides, and probably you can. Yes, so as I said, it's a very simple product. What is the process? There, as per definition, large cap stocks are stocks number 1 to 100. Nifty 50 is stock number 1 to 50. Out of this Nifty 50 stocks, the top 10 stocks basis 6-month average of free float market cap become a part of this portfolio. So again, Nifty 100 to Nifty 50, another filter at Nifty 50 level, which gives you top 10 stocks based on 6 months free float market cap. Looking at how they've done, if you look at this chart, they've done relatively better than even Nifty 50, Nifty 100, or the broader market, which is Nifty 500. So the top 10 names over the larger period of time have done well, even with a portfolio to the scale of Nifty 500, which has some constituents of mid cap and small cap. So it has across time frames proved its mettle by delivering better returns in 12 out of 16 years in the history. How has it performed? Another small chart to show you performance 16 versus 15 over the last 1 year. It is more or less slightly better than what a Nifty 50 is done. It is just that the structure is different from what we generally hold. I will just spend 1 minute on this slide. Let's not get confused by what it shows. It is very simply a depiction of a light blue and a dark blue line. Dark blue line is the underperformance of Nifty top 10 stocks versus Nifty 50, or relative performance of Nifty top 10 versus Nifty 50. Whenever the dark blue line has come below the average line, going forward, the top 10 stocks have done better than the overall Nifty 50. Very simply put, over the last 3 years, top 10 stocks have been underperforming Nifty 50 as the broader index. Whenever historically we've seen that the 3 year rolling return for Nifty Top 10 has been lower than the broader Nifty 50. Going forward, top 10 as a basket has done much better than what Nifty 50 is done. Another reason why top 10 today, historically, if we look at the total market cap of the market, the top 10 stocks hold or have held about 35%, 36, 30 to 38% in average in terms of their contribution in the total market cap. Over the last few years, this contribution in market cap or their weightage in total market cap has dropped from 35 to 21. So today they are at their lowest in terms of their participation in total market cap. Another reason why we feel investors should look at this polarized strategy, because they are providing today relatively better margin of safety and have underperformed in the recent past. Uh, Another aspect, just to add to this, is how they've done in negative markets. So, yes, we've spoken about how they've done in terms of overall returns. But if you look at the number of green bars below Nifty top 10 equal weight, you'll see in years, or this is a data for almost 15, 16 years, barring 4 to 5 years, Nifty top 10 has fallen relatively lower than Nifty 50, obviously lower than Nifty 100 and Nifty 500. So the most number of dark green bars that you see here are in Nifty top 10. So this is a basket of top 10 names which give you comfort during downturn, which give you market plus slightly higher returns, or which have given market plus slightly higher returns over the longer term, and in terms of quality are available at better valuations and technical parameters. So I'll only talk about two: return on equity. The top 10 basket has a return on equity of almost 22, while Nifty has of 15. So almost 1.5 times more return on equity than Nifty 50. The basket of top 10 stocks have. Also, if we look at the another parameter, which is return on assets, again, where the Nifty 50 basket has an ROA of 2.7%, Nifty top 10 equal weight has an ROA of 10.4. So if I have to combine how they are as stocks, so we are looking at something which defines their quality. Uh, how What is the construct of that stock? Second, we look at the historical sustainability or relative comfort during times of correction, and the recent underperformance. These three broad reasons are the factors where we think investor can look at this fund, uh, to invest in this fund in this time. It is very difficult for an investor to decide to pick a fund which is not done well in the recent past. If you look at the recent history, most of the funds or most of the investor flows have gone to either small or mid cap funds or sectoral thematic funds. Large cap, as a broad idea, is probably receiving the least amount of inflows. So yes, this segment is underperformed, and hence you should invest in this fund, rather than saying there's a huge recent outperformance and then you should invest in this category. We believe the recent underperformance will revert to its mean and give investors a opportunity to earn decent returns using this strategy. I think that's what I wanted to show in these 4 5 slides. So we can just stop the presentation and probably uh, take up any questions or other aspects if you want to discuss about this product.
Yeah, I mean, you've really put all of those details very well into perspective, in particular, a little bit more as well about the ROA of this fund. But let's also understand a little bit more now. Given the fact that you do have the Nifty top 10 equal weight index, Nifty 50, the comparison keeps happening. And I know you highlighted that as well. But ये different कैसा है? If you can tell us, how is an equal weight strategy different from a market cap strategy when looking at this? If you could just elaborate a little bit more on that.
Sure, sure. So that is the basis foundation of this product. So let me also add that at DSP we already have a Nifty 50 index fund slash ETF. We also have a Nifty 50 equal weight index and ETF. Now what we're doing is Nifty 10 equal weight. How is it different than, let's say, the broader Nifty 50? First, Nifty 50 is stock number 1 to 50. Here, the stock count is 10, which is 1 to 10. Second, how are these stocks selected? In Nifty 50, the stock is selected again on free float market cap based average of last 6 months. Similarly, in Nifty Top 10 also, it is based on free float market cap of the top 10 stocks. So, two differences. First, it is not market cap based, it is equal weight. In Nifty 50, it is market cap based. Higher the market cap, higher weightage in the portfolio the stock has. Lower the market cap, lower weightage the stock has in Nifty 50. In Nifty equal weight top 10, that is not the scenario. Whether you are rank 1 or you are rank ninth, your weightage is going to be top 10 only. Second, Nifty 50 is a construct of 50 stocks. Nifty 10 is a construct of just the top 10 stocks.
Okay, so that is giving us the basic difference, equal weight strategy, and how that's different from market cap strategy. Now, Gurjeet, I also want to understand in terms of the commonality percentage of the Nifty Top 10 Equal Weight Index and the Nifty 50 Index. Can you give us some perspective?
Sure. So while we have been talking about this product to a lot of people in distribution, to our investors, there's a common question which comes as to it appears to be a concentrated portfolio, but the truth is 53% of Nifty 50 is made up of the set of these 10 stocks. So almost 50% of Nifty 50 index is based on Nifty 10 equal weight index. So there is a commonality of about 53% as on 31st July. Some amount of deviation may have happened over the last 20-25 days. But yes, as of last month end, the common factor was 53. So more than half of the Nifty 50 portfolio is built of Nifty top 10 construct.
Okay, and do you think that this strategy maybe should be chosen in place of the Nifty 50 or Nifty Top 10 Equal Weight में choose कैसे किया जाए?
Well, yeah, it's I think from an investor's perspective a very good question because we cannot deny the fact that this product is a built of only top 10 stocks and hence it is a concentrated portfolio. So it will depend first on the investor's risk profile. If the investor is open to the idea of holding on to just the top 10 names, but then we also need to understand these are the top 10 names in Nifty in terms of free float market cap. So, an investor who uh, prefers a broader market product should actually invest in a Nifty 50 index fund. Someone who has the risk appetite to have a basket of only the top 10 stocks can look at this portfolio. Having said that, this basket over the recent past 1 year, 2 year, 3 year performance has underperformed Nifty 50. So, an investor who's looking to use this opportunity or to tactically use this opportunity to play the recent underperformance or to play the mean reversion in the top 10 stocks performance going forward can also look at this product. The third aspect is if you look at if as an investor I am looking at this product as a part of my large cap allocation, then it really does not make a difference. If this is the only product in my large cap allocation, then yes, it is just a basket of top 10 stocks. But if it is a part of a larger large cap holding that I have, this does make sense to hold on to an investor. So, yes, it will depend on an investor's risk profile as well as is the investor open to take a tactical allocation in this segment or not.
Understood. So that is also dependent a lot on the investor. But Gurjeet, tell us which are some of the sectors that are part of the Nifty 50 index and that are missing in the Nifty Top 10 Equal Weight Index?
So, since the portfolio is made up of only 10 stocks, it is bound to miss some of
Yeah.
the sectors because 10 stocks cannot give you exposure across the market sectors. Some of the sectors that as of now are not part of Nifty top 10, and subsequently when the in future if they perform really well, if there is stock which comes into top 10 and qualifies basis the criteria of selection, those sectors can get included. But as of now, it's a automobile, NBFC, metals, healthcare. These are certain sectors which are not part of top 10 but you might get an exposure to them in Nifty 50. Today, even a telecom is not a part of the top 10 index as a sectoral exposure. But basis report that NSE is published about a rebalance that will happen in the month of September, there is a probability that telecom, some exposure to telecom might come in the top 10. But as we speak, telecom, automobiles, NBFCs, metals, healthcare are some of the sectors that investor will not get in the top 10 equal weight strategy.
Fair enough. And since we're narrowing it down to the top 10, there obviously can't be exposure to multiple sectors, but nonetheless, getting a nice diversification across the main ones. And since index में कुछ important sectors missing है, does it still warrant an investment? I'm sure a lot of investors have that first question.
Uh, It does in a sense because eventually, if you look at the long term performance of this index, it has done slightly better than what the other indices in the large cap space have done, namely Nifty 50 and Nifty 100. So, in spite of having a basket of only top 10 stocks in equal weightages, it has performed better than the other indices. So, we can't really say that since it has only top 10 stocks, the performance will also take a hit. That is not the case. Also, if if there is a polarized market today, what we have is a depolarized market, which means a larger part of the market is participating in the up move. There are periods when a small set of stocks only lead the market rally. If that is the case and a polarization in large cap stocks happen, this set will do meaningfully well than the broader Nifty 50 index. We've seen that happen in 2017, 18, 19 period when the set of few large cap stocks did much better than what the larger Nifty 50 index done. So yes, though there are limited names, limited sector exposures, historically it has done well. And if there is a polarized market, a investor stands the opportunity to benefit by taking a allocation in Nifty top 10 equal weight strategy.
And has the Nifty Top 10 Equal Weight Index then outperformed the Nifty 50 Index and the broader market Nifty 500 Index as well?
Yes, it has. In fact, that was, I believe, my second slide.
Yes, your
But yes,
introduction.
yeah. So Nifty top 10 has done well. If you look at the data from 2006 till about July 2024, Nifty top 10 equal weight has delivered a return of 14.5%, close to 14.5%. Nifty 50 is around 13.7 to 13.8. So it is slightly more than the broader Nifty 50 index. And if you look at an even broader index, which is let's say Nifty 500, there also it has outperformed. So a set of top 10 stocks outperforming Nifty 50 historically as well as Nifty 500.
Okay, understood. Indeed, it has outperformed the Nifty 50 and the broader market Nifty 500 index. So, if you could just, elaborate a little bit more, Gurjeet, because इसमें rebalancing and reconstitution की क्या frequency है?
Okay. So these words will keep coming back to anyone who's reading, listening, or trying to inquire about this product, reconstitution and rebalancing. So, reconstitution will happen twice a year, which is March end and September year. So, every 6 months, a rebalance happens, reconstitution happens, which means that if there is a stock which qualifies in the top 10 equal weight strategy based on the methodology of the index, the stock will replace a stock which is supposed to go out. So a change in stocks is reconstitution, which happens semi-annually. The part of the strategy is equal weight. So every quarter there will be a rebalance of weightages. So let's say if we look at the names today, there is a possibility of a name moving from 10%, having done well, moving from 10% to 11%, and correspondingly a stock not doing well, moving from 10 to 9.5 or 9.4, just for an example. So every quarter, the weightages will be realigned to 10%. So let's say whatever has moved from 10 to 11.5 will again get realigned to 10%. what has underperformed will be bought into. So if there is a stock which is at 9.4%, will be bought into, and the weightages will be realigned to 10%. So the weightages getting realigned to 10% happens on a quarterly basis. A change in stock, if any, will happen semi-annually.
Okay, understood. And we certainly are hearing a lot about the rebalancing and reconstitution. Now, let's get a little bit specific, talk about some of the blue chip companies, Bharti Airtel, for instance, SBI जैसे blue chip companies, Nifty 50 का part क्यों नहीं है, in spite of the fact that they are part of the top 10 holdings of the Nifty 50, Gurjeet?
Okay. सो आई सिंप्लीफाई दिस. निफ्टी टॉप 10 जब आप देखते हो तो उसके अंदर में एसबीआई और भारती हैं, बट जब आप निफ्टी टॉप 10 इक्वल वेट देखते हो तो उसके अंदर आज एसबीआई और भारती नहीं है. सो फॉर अ स्टॉक टू गेट इनटू दिस पोर्टफोलियो has to have a free float market cap of 1.5 times of the least or the smallest stock in Nifty top 10. So I'll simplify. Let's say 10वें number stock in Nifty top 10 equal weight का market cap is 100. For a stock to replace that 10th number stock, the free float market cap 6-month average has to be 1.5. Only then that stock will come in place of, let's say, a stock which is at 100. Today there might be a case where some of the stocks that you've discussed would be in the top 10, but let's say their market cap is only 1.25 times of the 10 stock. So until unless they breach the level of 1.5 times of the smallest stock in the Nifty top 10 equal index, they will not become a part of this index. uh, as I said, as per, and there is a probability as per the NSC release that there could be a stock change happening, and one of the stocks that you've mentioned could become a part of this portfolio in the next reconstitution. But we'll have to wait till the time that happens. But that's the logic. For a new stock to come in, it has to be 1.5 times of the least or the smallest stock in terms of market cap, free float market cap in the Nifty top 10 equal weight.
Okay, got it. Point taken. So we will perhaps see some activity with, one of the perhaps blue chips entering when we see the rebalancing takes place. And I think this is going to be a question, Gurjeet, which will be on everyone's lips. Why is this a good strategy? Because a lot of large cap, even multi-cap portfolios, they have allocations to these companies. So wouldn't it lead to concentration risk, in your opinion?
It will not, and as I said earlier, अगर आप overall large cap का allocation देख रहे हो अपना, let's say if my portfolio is 40% large cap or 30% large cap, I want to make it today 40% large cap, I can use this strategy to add that 10%. See, we cannot deny the fact that historically this strategy has worked well, or slightly better than the broader index. Plus, it has on various occasions, many years, done better than even the average returns of active large cap funds. So funds that have this segment as a part of their total allocation have underperformed in various time frames, or the Nifty top 10 equal weight has over outperformed the average large cap universe in most of the years. So a holding in this strategy looks concentrated, but is actually, as I said earlier, it is 53% of Nifty 50. If we look at the profit pool of Nifty 50, these 10 companies contribute to almost 49% of the profit pool of Nifty 50. So these are the marquee names in their respective businesses. They've been there for a long period of time. Uh, they also are a part of investors' direct stock holding, probably, not just through mutual funds, and hence these are names that people are aware of. These are businesses that people might be aware of, and holding them through through a product can be beneficial in other ways also. So if I have to extend this, if I hold these stocks in my portfolio today, the dividend that I get is taxed at marginal rate. Wherein, if I hold that same set of stock in a fund structure, the dividend actually is getting reinvested in the same basket of stocks. Hence, the tax implication does not happen till the time I redeem my portfolio. or the product. Second aspect is every time there is a change in the index, if I do it at an individual stock level, there is going to be a transaction cost that I have to incur. Whereas when I do it at a fund level, again there is no tax liability on my hand or at my end till the time I actually withdraw the fund. But if I sell a stock and buy another stock, or I try and do this strategy at my end, every time there is going to be a tax implication that comes to my end, which is taken care of if we do it through a fund. So there are simple, it's a very simple, transparent, low cost mode of holding the set of top 10 Indian stocks in the equal weight strategy.
Okay, fair enough. And help us understand as well. Finally, the Nifty top 10 equal weight TR index का performance large cap funds के comparison में कैसा रहा? What is the category average, the percentage of funds that have outperformed? Can you just elaborate a little bit more? And can you give this to us across each calendar year on a period basis?
So I do have the data for the last 15 years, and I can tell you that out of the 15 years, there have been 11, at least 10 years where this strategy is actually outperformed the large cap funds average, the category average, not a specific fund. There would be funds that would have done well than this strategy, and there have been funds which have underperformed this strategy. But if we look at the large cap category average, most of the years this strategy is done well. If I have to put a number and let's say define a period, and even if we look at a rolling return basis, a 5 year return period, the returns for top 10 average 5 year returns are 13.8% for this index. So I'll repeat, on a 5 year rolling basis, Nifty top 10 equal weight TRI, the index, has delivered 13.8%, while the category average of 5 year returns of large cap funds is close to 12%. So on a 5 year rolling basis, this index is delivered better than the category average of large cap funds.
Okay. I think that we've definitely got an overall view. Thank you so much, Gurjeet, for giving us that in-depth perspective, putting the spotlight, as it were, on the DSP Nifty Top 10 Equal Weight Index Fund, and what the intricacies are with respect to the Nifty Top 10 Equal Weight Index, and the kind of outperformance as well that we have seen. The top 10 companies, they have clearly managed to stand the test of time. Lots of stability is what they have provided as well, and are providing due to the higher ROA and ROE. It's been a pleasure interacting with you. Thank you.
Thank you. Thanks a lot again, 5 Pesa team and Avan. Thanks you.